really it's going to depend on these earnings to kind of get my finalized decision on what I want to do with the HIMS shares. But for now, being patient, selling covered calls weekly below my cost basis, not something I recommend at all. Sector. So, STX, beautiful chart, great premiums. PE ratio still on the lower side, given it's an AI stock, 44 PE, not bad in comparison. Let's see where NVIDIA is at actually. NVIDIA is at 46, so kind of right in line with NVIDIA. Obviously the margins aren't as big as NVIDIA, but still a decent PE for the AI sector. Now, it's had quite a run up. So my future outlook is that I'm actually slightly neutral on STX, neutral to maybe even short-term, slightly bearish in the short term. I think that we could have a decent sized pullback back down to this 320 area, maybe 315. There is some support there, and that's kind of what I'm looking out for. I'm not trying to, go too heavy in my position, too high up. I want to stay below 315. CLS, I'm more bullish on. I'm selling aggressive covered calls, and I expect them to get called away. But on the upside, there is this 338 level that I think will be tested, okay, to the upside. And then if it breaches through there, who knows? We could be in the 360 to 380 area. So that is kind of my upside targets for CLS. I don't think there is some institution, some big buyer down here at 274 that, every time this thing hits that level, there's just a bid there. There's just someone coming in and buying up the shares because it'll hit this level real quick in the morning and then it'll bounce back up to like 300. So it's kind of crazy to see that. Next one is SoFi. Okay, SoFi, I'm very bullish on. Very, very bullish at these levels. We haven't seen these levels. I mean, the first time that we saw these levels were back in August of last year, okay? And we're getting the same prices, even though they've had amazing earnings in between there. So right now, towards the lower Bollinger Band, I think upside target for earnings is like, let's call it 2880. If it breaches that, we'll be somewhere here between 29 and 30, okay? That's kind of my short-term target. I am bullish, so I do think it's going up. Palantir, again, very, very bullish on Palantir. It's close to that 200-day moving average, really kind of solidifying this trend line here, forming that nice bear or bull flag. It did hit the 161 area, which we bought some leaps this week, profited on those. But right now, okay, my current position is of a bunch of cash secured puts at 175 and 185, 196K worth. And if I were to play it today, if I wanted to play earnings, I'd go out to Feb 6 to earnings week, plus or minus $20 move. So this thing essentially could go down to 150 or up to 190. And that's where I think it's headed. That is my kind of price target is 190, which there is some resistance there. Now, if we could get to this 190 area for earnings and build momentum, boom, I think we're headed past previous all-time highs. So that's kind of my long-term price target is 190 and then 210. 210 will be the next stop.
Our stock is not going to be a surprise. As a matter of fact, I just bought more of this stock yesterday, but it's Meta. Meta's at a point where it's so cheap that I don't even care if it falls more because I will just DCA into it at lower levels. But right now, Meta is trading at one of the lowest valuations in its history. Its forward PE dropped down to 20. Do you know how ridiculous that is for Meta? This is a company that routinely trades in the high 20s, low 30s in terms of PE. It has gross margins of 82%. Its revenue compound annual growth rate is 15% for 3 years, about 14% for 5 years. It generated almost $45 billion in free cash flow. Its free cash flow and compound annual growth rate for 3 years is almost 20%, for 5 years is almost 19%. And it recently laid off more than 1,000 employees from the metaverse. It is really one of two companies, Alphabet being the other one, that has such a large ad revenue business that it can sustain all the spending that it's doing. And it is one of the only companies that's making a significant amount of money from AI because it enhances the advertising business, the core business, by using AI. So as of late 2025, Meta's AI-powered ad tools have achieved a revenue run rate exceeding $60 billion annually. That's almost a third of its total revenue, by the way. It reports earnings on January 28th, but down 23% from highs with the forward PE of 20. I don't care what happens to Meta's stock price. I'm buying it here. This is not a trade, but this is definitely an investable position in my opinion. Now, next up, we have Netflix. If you're a fan of this channel, this is no surprise. I told you guys my target was 82. Go back and watch the last, I don't know, 4 or 5 videos. 82 was a target I was waiting for because it hit these equal lows. Netflix finally hit 82. Actually, its low was exactly 81.93. Now, I don't think, in my opinion, that this is the exact bottom for Netflix. It can suffer really big drawdowns. And I'm looking at the previous high in 2021 of about 70. These are post-split prices, obviously, as my next buy point here. I don't know that this is the absolute bottom for Netflix. I think that there's still quite a bit of negative momentum from the large acquisition they had to make. And the market might want to see even cheaper multiples before picking it up. Now, for the third stock, there's so many stocks I can talk about here. You can't isolate every buyable stock to just a list of 3. And there's going to be people that are like, oh my God, I can't believe you didn't mention SoFi, and I can't believe you didn't mention PayPal, and I can't believe, come on guys. But for instance, Microsoft hasn't been this cheap in a very long time. However, Microsoft's chart here does look like a falling knife, and we do have a huge honking gap down here. So I might wait a bit on Microsoft. Obviously, you have the data center stocks, which I think from a short-term perspective, I do like a lot of these setups and I continue to trade these, but that's not what I'm talking about in this video. And there are stocks which I think are an absolute monopoly, like ASML, which I've been in since 600, more than doubled my money on this stock. But with the fact that we have 107 new fabs coming online through 2028 worldwide, ASML will likely need to be involved in almost every single one of these. And fabs are just a fancy word for a, let's say, a factory or fabrication plant that produces chips. So I do think ASML will continue to go up, but I'm already in it, and right here, you're buying it at the all-time high. I already mentioned Costco, and this is up over $100 per share. But in terms of undervalued businesses, I'm looking at MasterCard and Visa. The deadline for capping credit card interest at 10% is already passed. It was January 20th. The banks didn't do anything. And although I agree with it in theory, I don't like the idea of usury. I don't like the idea of predatory rates. The way that credit cards work, if we're all going to have credit cards, is they have to charge a higher interest rate to those who are higher risk. And that allows those of us who are lower risk to get a lower rate. So if credit card interest was capped at 10%, that means that banks will likely not offer credit to that many people because it won't take any high risk individuals. And that means that there will be less people buying shit, and that will be bad for the economy. And in order to do that, Congress has to pass a law. There aren't too many people that are on board with this. However, this is one of those extreme suggestions by the president, which then in turn likely will put the issue of high credit card rates on the table and put it at the forefront of the American mind, and that way try to force credit card companies to either come up with promotional rates or try to be a little more aware of the rate that they're charging, but there can't be an enforcement at 10%. And so credit card and Visa tanked almost 15% because of that news. And as you guys know, I like to invest in undervalued monopolies, in this case, a duopoly. Credit card, MasterCard and Visa own most of the credit card transactions around the world. Now, one other thing, if you pull up the 500-day moving average, both MasterCard and Visa have never not recovered from hitting that unless we were in a bear market. This is 2008. This right here is 2022. This little blip right here is 2020. And we are now near the 500-day moving average on both MasterCard and Visa. Now, what I like about both of these companies is they have consistent buybacks. More importantly, like I said, they are a duopoly. And they have one of the highest gross margins out of any business. Like, what is their margin? They just charge transaction fees for every single transaction that goes that takes place around the world. So their gross margins are almost 100%. Current forward PE sits at around 25. And really, Visa and MasterCard are just safe stocks with very consistent, modest growth. So if we get down to the 500-day moving average, which is around 315 for Visa and about 520 for MasterCard, then I do not mind picking this up for the very long term. And just a bonus, another stock that I'm currently looking at is Robinhood at the 200-day moving average. Now, something like Robinhood is going to suffer a major downturn if we did have a correction because it's a high beta name. But in regular market conditions where we have pullbacks and then continue higher, stocks like Robinhood tend to do well. So those are the 3 undervalued stocks that I'm looking at right now. I do think that there are quite a few short-term trade ideas in the works that I will be sending out, obviously, if I take them in the Traveling Trader Academy. But if you look at some of the data center stocks, they all have a very similar pattern here where they have broken out and are retesting previous resistance levels as support. Today, we took a position on SMCI. That position is already up 30% as it broke out of the small downtrend here, retesting that 921 EMA. Also, if you look at the volume, this is the highest volume since June of last year. SMCI tends to have a habit of running pre-earnings, and its earnings is due in about 3 weeks from now. So we could see a little rally before earnings. Also, if you pull up the RSI, you can see that it was oversold, and we do have bullish divergence here with the RSI making a higher low while price made a lower low. So I want to see a push here from SMCI out to at least the 35 range and above.